Good morning and welcome to Market Monday for December 15th, 2025. As widely expected, last week the Fed lowered interest rates by 0.25%. But did you notice how he started the press conference? And specifically, which words did he use? And why does that even matter? Well, according to Polymarket, the world's largest prediction market, going into Powell's press conference, there was a 99% chance that he would have started with the greeting, "Good afternoon." And apparently the last time Fed Chair Powell didn't start the press conference by saying good afternoon, the Dow Jones stock market sold off by nearly 1,000 points. So did he?
Good afternoon.
What a relief. And despite being a silly anecdote, this does bring up a more important point, which is correlation and causation. We often look at charts, lines on charts, and they often compare one thing to another or attempt to draw some sort of relationship between two things. And we've looked at this several times over the years, talking about spurious correlations. Here's another one, the price of Bitcoin. Add the stock price of Boeing. And if I have a narrative to push, I may say that somehow these two lines have something to do with one another, when in fact, it's just a completely spurious correlation. Here's another even sillier example. This guy up here seeming to push the truck, he's moving forward as if he's pushing the truck, and he's moving as if he's actually pushing it, but clearly he isn't. That's correlation, which has nothing to do with the causation that's actually moving the truck. So when folks make a big deal about the words with which Jerome Powell starts his press conference, like it has any effect on the market whatsoever, we very much write that off as entertainment. What does have a little more relevancy in terms of correlation? Cycles. Specifically the presidential cycle and midterm election years, like next year. This is going back 125 years. Here's the first year of the presidential cycle here, which we're wrapping up right now. And here's next year, flat, grinding, choppy. The worst, historically speaking, of the 4-year cycle. And just history. It's not just the worst from a gains perspective, it's also the worst in terms of drawdowns. And here's another look. Here are all midterm election years, the grinding, the choppy nature, and here's all the years up here. And here are the drawdowns, meaning how much did the market sell off from its highest point in the year. Of course, no one likes drawdowns, but should we really care that much? Don't we know drawdowns are a part of investing? They're a feature. We should expect them and even welcome them. If we know it might come and expect it, maybe we can get prepared and even take advantage of it. And after all, we know that historically speaking, the S&P 500 stock market has been up just about 3 out of every 4 years and has only been down more than 20% 6 times in the past 100 years. But it's been up over 20% 36 times during the same time. And today we'll leave you with this. One of the main reasons we typically don't use individual stocks and we opt instead for ETFs that hold many companies is that single stock risk often outweighs the benefits. Cisco stock, one of the market darlings during the dot-com bubble, after 25 years has finally recovered from the dot-com crash. Have a great week.